Hi, I'm Garth McKenzie from traderscorner.co.za, and this is your weekly look at the S&P 500 and the Nasdaq indices. So we start with a look at the daily chart of the S&P 500, and what's evident here is that the market appears to have traded into a fairly large symmetrical triangle over the last 3 or 4 months. You can see the various waves of the triangle pattern labeled there, labels 1, 2, 3, and 4, and typically a triangle pattern will break out on the fifth wave. That is exactly what seems to have happened here. The break above 3,500 is a bullish breakout. So whilst the market is above 3,500, one has to still give the benefit of the doubt to the upside here and assume that the bulls have got the upper hand. What you can also see in the top right-hand corner of that chart is a smaller triangle pattern or perhaps a pennant pattern. And that also is a continuation pattern which one would expect to possibly break to the upside. But you'll see when we look at the hourly chart in a moment how that plays out and what level we need to watch there in order for that market to break to the upside. So let's then take a look at the hourly chart of the S&P 500. And there you can see that smaller triangle pattern that I mentioned on the previous chart illustrated in more detail there. The levels that we've got to really watch at the upper end are 36.25. That's the top of that triangle structure. And then down at the bottom, 35.50 is where support comes in. In the middle of that chart, 35.85 is an interim resistance level, and that level would need to be broken to see the market push up to 36.25. If this S&P 500 can then break out above 36.25, then that would be a pretty bullish development, and that would actually open up further gains, possibly to a measured target of around about 3,800 if we take a measured target from the triangle structure on the daily chart that I spoke to on the previous chart. So overall, looking quite good here. And whilst the market is above that 35.50 area, I think one has to give the benefit of the doubt to the upside. But above 36.25 is really what we need to see in order to open further proper gains to get the market going into the end of the year. Then let's take a look at the Nasdaq. This is a daily chart of the Nasdaq here. What's interesting to note is that on a relative basis, this market is slightly underperforming the S&P 500 at the moment. Whereas the S&P 500 is close to all-time highs, the Nasdaq is still trading a little bit below its all-time highs. And that talks to the theme at the moment of a bit of a rotation away from the hectic growth sectors of the market, the heavy growth region, the tech sector, etc., into the more old economy type of value stocks. And that's why you're seeing an outperformance of the S&P 500 over the Nasdaq at the moment. Now, in terms of this chart structure for the Nasdaq, 12,200 is overhead resistance, and that would need to be breached to the upside in order to open further gains for the Nasdaq, and that would then push us higher into the end of the year. If we take a look then at the hourly chart of the Nasdaq, this shows the critical levels in somewhat more detail. There you can see that for the last week or two, this Nasdaq has really been quite range bound between about 11,800 and 12,000. We'd need to see a break above 12,000 in order to open a push up to 12,200, and then obviously above 12,200 would start to open up new all-time highs for the Nasdaq. On the other end, if this market were to break down below 11,800, then that would be a near-term bearish break for the Nasdaq and could see the price moving a little lower towards about 11,500. But I think generally speaking, for both the Nasdaq and the S&P 500, for the time being, the bias is actually still to the upside, and we'd probably be looking for those overhead resistance levels to be broken to the upside in order to open further potential gains as we head into the end of the year. That's all I've got for you this week. I'll be back again next week with another look at the S&P 500 and the Nasdaq indices.